Hello everyone, welcome back to MoneyPulsar. In this video, we are going to talk about a hidden financial risk in 2026 that most people are not discussing openly. This video will help you understand why many tech companies are taking huge loans, how this silent debt can slowly affect jobs, salaries, and savings, and what smart people do differently to stay safe without panic. I'll explain this using simple real-life stories, step-by-step examples, and no confusing finance words. The story will slowly build from companies to the system, and finally to how it reaches normal people like us. So make sure you watch till the end, because the last part will help you see money very differently in 2026. Okay, let's get started. Imagine a big, successful tech company. Let's call them Future Corp. From the outside, everything looks great. They have shiny new offices, they're hiring talented people, and their products are everywhere. We all assume they're making tons of money. But what if I told you that Future Corp has been quietly taking on massive loans? Not for new buildings or big projects, but just to keep the lights on and pay their employees. This is a real trend happening right now. Many companies, especially in the tech sector, are borrowing heavily. Why? Because for years, interest rates were super low. It was almost like free money. They used this cheap debt to grow fast, expand, and outpace their competitors. It was a race, and everyone wanted to be first. But now, the party is slowing down. Interest rates are rising. That cheap debt is suddenly becoming very expensive. Think of it like using a credit card with a 0% introductory rate. It feels great at first, but when that promotional period ends, the high interest kicks in, and your payments skyrocket. This is what's happening to companies like Future Corp. Their monthly debt payments are getting bigger and bigger, eating into the money they should be using for innovation, research, and even salaries. This is the first domino. A company that's drowning in debt has to make tough choices. They start cutting costs. They might freeze hiring, reduce employee benefits, or even lay people off to stay afloat. And this isn't just one company. It's happening across the industry. Now, how does this ripple out and affect the bigger picture? The system itself. When dozens of Future Corps start cutting back, it creates a chain reaction. Fewer jobs mean people have less money to spend. When people stop buying things, other businesses suffer. Not just tech companies. Coffee shops near tech campuses see fewer customers, local restaurants have empty tables, and even the real estate market in those areas can cool down. It's a quiet slowdown. No big crash, no dramatic headlines, just a gradual tightening. Banks also get nervous. They see these big companies struggling with their loans, so they become more cautious about lending money to anyone, including small businesses and individuals like you and me. Suddenly, getting a mortgage or a car loan becomes much harder. This is how the debt of a few big players can quietly squeeze the entire economy. So, this is where it hits home for us, for normal people. How does this hidden risk affect your job, your salary, and your savings by 2026? First, job security. If you work in tech or a related industry, the risk is direct. Companies under financial pressure are more likely to have layoffs. But even if your job is safe, your salary might not grow. When companies are focused on paying off debt, raises and bonuses are often the first things to get paused. Your income might stay flat while the cost of living keeps going up. This means your money doesn't go as far as it used to. And what about your savings and investments? If the stock market gets jittery because of this corporate debt, your 401k or stock portfolio could take a hit. It feels unfair. Right. The decisions made in a boardroom years ago can directly impact your financial future. But here's the most important part. What can you do about it? Smart people aren't trying to predict which specific company will struggle. Instead, they focus on building their own financial foundation. First, they prioritize having a strong emergency fund. This isn't just about covering 3 to 6 months of expenses. It's about creating a personal buffer against uncertainty. It gives you the freedom to make choices, not out of desperation, but from a position of strength if your job is affected. Second, they focus on diversifying their skills. In a tight job market, being a specialist in one narrow field can be risky. They learn new skills, maybe in a related industry, making themselves more versatile and valuable to a wider range of employers. Think of it as having multiple fishing lines in the water. Third, they review their own debt. While big companies are struggling with their loans, smart individuals make sure their own finances are lean. They pay down high-interest debt like credit cards, which frees up their own cash flow, making them more resilient. Finally, they stay informed but don't react to every headline. They understand the bigger picture we've talked about today and make calm, long-term decisions for their investments and careers, instead of making emotional moves based on fear. By focusing on what you can control, your savings, your skills, and your own debt, you can turn a period of uncertainty into an opportunity for growth. Now, let's understand the problem with a simple story. Imagine a large software company called SkyGrid Systems. SkyGrid provides cloud services to thousands of businesses. In the last 2 years, SkyGrid borrowed a very large amount of money to build powerful AI data centers. This move was strategic. With the AI boom, everyone from startups to giant corporations needs massive computing power, and SkyGrid wanted to be the go-to provider. They saw a future where their data centers would be running at full capacity, generating incredible profits. So they went to the banks and said, "We need a few $1 billion to build the future." And the banks, looking at the unstoppable rise of AI, agreed. They saw SkyGrid not just as a company, but as a key player in the next technological revolution. This looks like a classic business growth story, right? A company invests heavily today to reap massive rewards tomorrow. But what's really happening under the surface here? Let's break down this financial maneuver. SkyGrid took out huge loans. This means they now have a massive pile of debt. This debt isn't some abstract number on a spreadsheet. It's a real-world obligation that comes with interest payments, deadlines, and a lot of pressure. Every month, a significant chunk of cash has to go to the lenders, regardless of how the business is doing. On the other side, you have the promise of future profits. The brand new AI data centers are state-of-the-art, but they aren't generating their peak income just yet. It takes time to sign contracts, onboard new clients, and ramp up operations to full capacity. So, SkyGrid is in a classic invest now, profit later situation. This is a very common strategy. Think about it. Almost every major company you know, from automakers to tech giants, has used debt to fund big projects. It's a tool to accelerate growth, to seize an opportunity before a competitor does. But this is where the timing mismatch creates a delicate balancing act. The debt exists today. The interest payments are due today. The financial obligations are very, very real and immediate. However, the massive income stream that's supposed to pay for all of this, that's in the future. It's an expectation, a forecast, a promise based on market trends and business plans. The banks loaned SkyGrid the money because they believe in that future. They trust that SkyGrid's leadership knows what they were doing and that the AI market will continue to explode. The entire financial structure is built on this trust and the assumption of future growth. As long as everything goes according to plan, this is a brilliant move. SkyGrid gets a head start in a lucrative market, and the banks make a healthy return on their loan. It's a win-win scenario. But what if things don't go exactly as planned? This is the core of the issue. You have a very concrete, unchangeable reality that attend a very flexible, uncertain future, the projected income. SkyGrid's entire stability now rests on a bridge between these 2 points in time. A bridge built out of assumptions. The assumption that the demand for AI computing will meet their forecasts. The assumption that competitors won't suddenly launch a better, cheaper service. The assumption that the broader economy will remain stable, so their clients can continue to afford premium cloud services. This looks normal on the surface, a company investing in its future. But this is where the risk begins. Every one of those assumptions is a potential point of failure. The bigger the debt, and the further away the promised profits, the more fragile that bridge becomes. And if that bridge starts to crack, the consequences can be catastrophic, not just for SkyGrid, but for everyone connected to it. Now, let's look at this from the lender's side. To really understand the whole system, we need to meet our next player, BlueStack Capital. Let's imagine BlueStack is a big-name finance company, a lender that specializes in funding the tech industry. They're not just lending to one or two startups. Their portfolio is huge, with money out to hundreds of different tech firms. So, how does a company like BlueStack operate? Their business model is built on a simple but powerful idea: diversification. They know that in the high-stakes world of technology, not every company is going to be the next big thing. In fact, many will probably fail. But that's okay, because BlueStack isn't betting on any single horse. They're betting on the entire race. They spread their investments across so many different companies, from software developers to hardware innovators, that they only need a handful of those firms to hit it big. When a few of their clients succeed spectacularly, the massive returns from those winners more than cover the losses from all the others that didn't make it. It's a numbers game, and for a long time, it's a game they've been winning. But here's where the system starts to feel the pressure. Let's introduce a new factor: rising interest rates. Imagine the central bank decides to hike rates to manage inflation. Suddenly, the cost of borrowing money goes up across the board. For you and me, that might mean our mortgage payments go up. For BlueStack Capital, it's a much bigger problem. The cost of their own borrowing, the money they use to lend out to startups, suddenly gets more expensive. This immediately squeezes their profit margins. To compensate, they have no choice but to pass on these higher costs. They start charging higher interest rates on their loans to the tech firms. Now, let's look at the effect this has on the startups. These small companies are often running on very tight budgets. They're burning through cash to develop products and grow their user base. They're not profitable yet. So when their loan repayments suddenly get more expensive, it puts immense pressure on them. Their financial runway, the amount of time they have before they run out of money, gets dramatically shorter. The startups that might have been on a path to success now find themselves in a desperate scramble for cash. They have to make tough decisions: lay off staff, cut back on marketing, delay product launches. The pressure to generate revenue immediately becomes intense. This creates a dangerous domino effect. Remember BlueStack's strategy. It relied on a few big winners to cover the losers. But with the entire tech sector under financial strain, the chances of any single startup achieving that massive breakout success start to shrink. The environment that once nurtured growth has become hostile. The higher interest rates mean fewer companies can secure follow-on funding. Consumer spending might also be down, meaning less revenue for these startups. The whole system is slowing down. So, BlueStack is now in a real bind. Not only are their own costs higher, but the companies they bet on are also more likely to fail. The winners they were counting on are struggling to win. The failures become more frequent. The whole portfolio starts to look sick. The model that seemed so robust is now teetering on the edge of collapse. And this brings us to the key lesson about system thinking. For BlueStack's model to work, the system depended on everything going right at the same time. It needed low interest rates, a steady flow of venture capital, strong consumer demand, and a general sense of optimism in the market. When just one of those key elements changed the interest rates, it created a chain reaction that threatened the entire structure. It wasn't one single bad decision or one failed company that caused the problem. It was the interconnectedness of the whole system. Each part influenced the others, and the negative feedback loop amplified the initial shock. This is why understanding systems is so crucial. It helps us see the hidden connections and potential vulnerabilities before a crisis hits. Now, let's bring this down to earth and see how these big, abstract changes actually affect real people. People just like you and me. I want you to meet Arjun. He is 29 years old, and he has been working his tail off at a tech startup for the past few years. He loves his job. The energy is great. The team is fantastic, and he truly believes in the product they're building. For a long time, things were looking up. The company was growing, and Arjun was growing with it. He was getting recognized for his hard work, and was on track for a promotion and a significant salary bump. He and his partner were even starting to look at putting a down payment on a house. Life was good. Then, one day, the company's leadership held an all-hands meeting. The vibe was different. The CEO explained that their cloud computing costs, the very backbone of their digital product, had skyrocketed unexpectedly. The startup, like many others, relies on a massive cloud infrastructure provider. Let's call them SkyGrid. Had just changed its pricing model. It wasn't a huge, dramatic announcement that made headlines, but a series of small, complex adjustments to how they bill for data transfer and processing. For a small startup that moves a ton of data, these small changes added up to a massive new expense, month after month. Suddenly, the startup's financial runway, the amount of time they had before running out of money, was cut short. The leadership team had to make some tough decisions, and fast. The first thing to go? The hiring plans. They announced a company-wide hiring freeze. All the open positions were closed, effective immediately. This meant everyone's workload just got heavier, as they now had to cover the gaps themselves. The dream of expanding the team and launching new projects was put on hold. A few weeks later, the next piece of bad news dropped. During performance reviews, the message was consistent across the board. No salary increases this year. The company just couldn't afford it. The money that would have gone to raises was now being funneled directly to SkyGrid to keep the lights on. So, Arjun, despite having his best year ever and exceeding all his targets, saw his salary growth come to a dead stop. The promotion he was so close to, indefinitely postponed. The dream of buying a house started to feel more and more like a distant fantasy. Here's the most important part of this story. Did nothing wrong. He was a modeled employee. He worked hard, he was innovative. He was a great teammate. But the environment around him changed. A decision made in a boardroom at SkyGrid, a company he'd barely even thought about, had a direct and painful impact on his life, his career, and his financial future. His world was turned upside down, not because of his performance, but because of a line item on his employer's cloud bill. This isn't just Arjun's story. This is happening to thousands of people in startups and even larger tech companies all over the world. They're caught in the crossfire of these infrastructure wars. They feel the pressure of rising costs. They see their career progression stall, and they worry about the stability of their jobs, all because of these hidden, complex pricing structures. It's a ripple effect that starts in the cloud and ends in our living rooms. It's a powerful reminder of how interconnected our modern economy is, and how decisions made by a few dominant players can shape the lives of so many. What if I told you that one company hitting a small bump in the road could quietly trigger a massive economic chain reaction? It sounds like something out of a movie, but it happens more often than you think. Let's break down how this invisible domino effect works. Now imagine SkyGrid delays its loan payments. This might not sound like a huge deal at first, but it sets off a hidden chain reaction across the economy. It's like a single domino falling, triggering a cascade you don't see coming until it's already happening. They're a big player, employing thousands and borrowing heavily from banks to fund their ambitious projects, like building a global satellite network. Everything seems to be going great, but then a critical project faces an unexpected technical setback. It's a major blow, and suddenly their projected revenue takes a nosedive. The cash they were counting on to repay their loans isn't coming in as planned, so SkyGrid has to make a tough call. They announce they're going to delay their loan payments. Now, from the outside, this might just seem like a problem for SkyGrid and its lenders. But this is where the first domino falls. The banks that lent money to SkyGrid are now facing a problem of their own. They were expecting that money back on a specific schedule. With that income stream suddenly uncertain, they get nervous. It's like a person who suddenly isn't sure when their next paycheck is coming. What do? They start cutting back on spending and taking fewer risks. For the banks, this means tightening their credit standards. They become much more cautious about who they lend money to. A small, promising startup, let's call them Innovatech, comes to these same banks looking for a loan to expand their operations. A few months ago, they would have been a perfect candidate. But now, the banks are spooked. They look at Innovatech's business plan and think, this is too risky right now. So, Innovatech's loan application is denied. This isn't just happening to Innovatech, it's happening to countless other small and medium-sized businesses across different sectors. Without that crucial funding, Innovatech can't move forward with its expansion plans. They have to put their hiring on hold. That brilliant software engineer they were about to bring on board, that offer is rescinded. The new marketing team they wanted to build, that's not happening anymore. They might even have to lay off some current employees to conserve cash. Multiply this by hundreds or even thousands of other startups and small businesses facing the same credit crunch, and you can see how job growth across the entire economy starts to slow down dramatically. Now, let's follow the ripples further. The people who were supposed to get jobs at companies like Innovatic, or those who were laid off, now have less money. Even people who still have their jobs start to get worried. They see the headlines about companies struggling and layoffs happening. They hear their friends talking about job offers being pulled. This creates a powerful feeling of uncertainty. And what do people do when they're uncertain about the future? They stop spending money on non-essential things. That new car they were planning to buy. They'll wait. The family vacation they were excited about. Maybe next year, the weekly dinner at their favorite local restaurant. They'll start cooking at home more often. This widespread drop in consumer spending is the next major domino to fall. Businesses that rely on this spending, restaurants, retail stores, car dealerships, travel agencies, start to see their sales plummet. The local restaurant that was always packed on a Friday night now has empty tables. To survive, the owner has to cut costs. That means reducing staff hours, or worse, laying off waiters and kitchen staff. The suppliers who sell fresh ingredients to that restaurant also see their orders drop. The farmer who grows the vegetables, the butcher who supplies the meat, everyone down the supply chain feels the pinch. And so it continues. The laid-off waiter cancels their gym membership. The gym, facing declining revenue, has to lay off a personal trainer. The personal trainer can no longer afford their weekly coffee from the local cafe. This is how economic stress spreads, quietly and insidiously, from a single corporate boardroom all the way down to the smallest local businesses and individual households. It's a chain reaction, where one negative event triggers another, creating a cycle that's difficult to break. It all started with one company, SkyGrid, delaying its payments. Understanding this chain reaction is so important because it shows how interconnected our economy truly is. It's not just about big corporations and banks. It's about real people, real jobs, and our collective confidence in the future. It's a powerful reminder that stability is a delicate balance. Now let's talk about what people who understand this system do differently. They play the game with a completely different set of rules. It's not about working harder, but working smarter within the framework we've discussed. First and foremost, they master the art of avoiding lifestyle inflation. You know how it goes. You get a raise, and suddenly your expenses magically rise to meet it. A bigger apartment, a fancier car, more expensive dinners. People who get ahead break this cycle. When their income increases, they don't immediately upgrade their lifestyle. Instead, they funnel that extra cash into assets, a side business, things that will generate more income for them down the line. It's about consciously choosing to build wealth for your future self instead of just trying to impress others today. This simple choice is one of the most powerful financial decisions you can make. Second, they prioritize flexibility above all else. Life is unpredictable. The job market shifts, industries change, and unexpected opportunities or crises can pop up at any moment. Relying on a single, rigid plan is a recipe for disaster. These individuals build multiple income streams. They might have a day job, a freelance gig, rental income, and a dividend portfolio. If one stream dries up, they have others to fall back on. They also continuously learn new skills, making themselves adaptable and valuable in any economic climate. This isn't about being paranoid. It's about being prepared. It's about building a financial fortress that can withstand any storm. Finally, they refuse to overdepend on one sector. Putting all your eggs in one basket is risky, whether it's your career or your investments. If you work in the tech industry, you don't pour all your savings into tech stocks. That's doubling down on risk. Instead, they diversify. They spread their investments across different industries, different countries, and different asset classes like stocks, bonds, and real estate. This diversification protects them from the boom and bust cycles of any single part of the economy. It ensures that even if one area is struggling, their overall financial health remains strong and stable. If this video helped you, like, share, and subscribe to Money Pulsar. Your financial journey starts here. Disclaimer: this video is for educational purposes only. Some details may be simplified. Please do your own research before making financial decisions.